revenue recognition over time with overall profit. We're looking at long-term contracts as part of our Chapter 5 revenue. And first we're going to go through how do you treat a contract that is profitable, whether it meets the criteria of percentage of completion, where you could recognize revenue over time, or it does not, and then you only recognize revenue and profit at the end of the contract. We're going to go through the process as well as the journal entries and T accounts, so hopefully it'll help you see how this process works. There are two accounting methods available for long-term contracts. There's percentage of completion, where you recognize revenue and gross profit over time after meeting certain criteria, and completed contract. You recognize revenue and gross profit only after the contract is completed. Now, long-term contracts. Steps 2 and 5 of the revenue recognition rules are critical for long-term contracts. Step 2, identify the performance obligations. Usually have a single performance obligation because don't meet the separately identifiable criteria, which means you have to have two parts that require different performance obligations that have separate fair market values. Long-term contracts does not apply to them. Step 5, recognize revenue when or as each performance obligation is satisfied. In this case, recognizing revenue over time, and under long-term contracts qualify, and this is, if it doesn't, we'd have to use completed contract. Now, here are the ground rules. The customer simultaneously receives and consumes the benefits of the seller's performance as the seller performs, or the company's performance creates or enhances an asset, for example, work in process, that the customer controls as the asset is created or enhanced. Or the company does not create an asset that can be sold to another customer. So, recognizing revenue when the three criteria do not apply, if the performance obligation doesn't meet any of the three criteria, we have to recognize revenue at a point in time, and for a long-term contract, it would be when the contract is complete, at least in these problems that you're going to be doing. So now let's take a look at an example. We start construction on January 1st to build a parking complex. We're estimating, and you got to remember at the beginning, you're estimating what your total costs are, and we're assuming it's going to take 3 years, which we're going to assume that's true, and the complex is going to be built, and we're hoping, well, we are going to build $900,000. Now, the problem you always have, this is known as a fixed price contract, is you want to make sure that those costs don't exceed what we can bill the purchasing company. Now, the following data pertains to the construction period. Now remember, we always need to figure out what the costs were, how long it was, and the total purchase price. Now, the most important is the $900,000. That's the maximum we can bill the client. Now we have this example. It shows us cost to date, and these are cumulative. So if you wanted to get like current year for 2019, you're going to have to subtract the $450 from the $270. Estimated cost to complete. Then we have progress billings to date. The difference between the progress billings to date, these two accounts, progress billings to date and cost to date, the difference between them is billings in excess of cost, and these both are cumulative. And then cash collected to date. Now, step 1, we're going to determine the percentage complete. You're going to do this for each year. So we're going to look at our estimated total cost, which is our actual cost plus estimate complete for the end of each year. Step 2, we're going to determine the formula, which is always going to be year-to-date cost divided by total estimated cost to complete, gives you your percentage of complete. And you're going to use that to determine how much of your revenue you're going to record. So, in our first year, 2018, total revenue is $900,000. We're going to determine percentage revenue earned. is going to be 270 divided by the total of 600 gives us 45%. Now we're going to determine the revenue to be booked, and we're going to take that percentage times 900,000, gives us 405. We're going to then subtract our actual costs, and that tells us how much gross profit we're going to book in the current year for percentage of completion. Now, our next year, 2019, total revenue is 900,000. We're going to do our percentage, which is going to be 450 divided by 600,000 tells us we're 75% complete, times 900,000 gives us 675. Now remember, that is the cumulative revenue that can be recognized. If we want only 2019, we have to back out what we've already recorded in prior years. So it's going to be 675 minus what we recorded in the prior year. Tells us in 2019 we can record 270 as revenue. And we had costs, which is the difference between the 270 and the 450, which gives us 180. And that tells us our gross profit for 2019 is 90,000. Remember, you must always subtract out prior year to date. Now, what about 2020? Now, we are 100% complete. So, the total costs are 610, so that's 100%. Now we're going to determine our revenue, which is really going to be the 900,000, which is the maximum amount because it's a fixed price contract, minus the amounts that we recorded as revenue in prior years. So for 2020, we're going to record 225. So less our expenses. Again, you need to subtract out the prior years. That's the number one mistake students make. And that tells us the gross profit for 2020. Now let's walk through the journal entries. So for 2018, we're going to book our costs of 270,000 against cash, but it would probably be various accounts, but we use cash in this example. For a homework, it would probably be multiple accounts, and that would be the description, multiple accounts. So that is, in essence, it's an asset on the balance sheet. So remember, this account is always cumulative, and what we're going to do is bill it every year until at the end of the contract, we are going to zero it out against the billings on construction. So in the end, in the final period, billings on construction and construction in progress has to equal the total amount of the contract, which is 900,000. Now, we show our billings on construction, which were 270. That is the offset. That's the liability. Construction in process is our asset. So these two offset each other on the balance sheet. Then we would record our collection of receivables, and then we're going to record our actual revenue for 2018. And in this example, we would see that we book revenue of 405 minus construction expense. These two accounts are on the income statement, and the net difference would be the 135, which would be our gross profit. We also have to debit that to the construction in process because that's the only way in the end the account will equal 900,000. And I'm going to show you that in T accounts. And gross profit is always a debt to construction in process because the billings and construction in process accounts must equal at the completion of the contract. Now, this is only if there's a profit. Now, let's look at the T account so you can see how this works. So this is what it would look like in 2018. There's 2019. There's 2020. And if you notice at the end, They both equal $900,000 at the end of the contract. And then after the contract is complete, we're going to zero those accounts out. Now, what do the journals look like if we had done completed contract? Since this is a profitable project, we would not book any expense or revenue until the contract is complete. Remember, no revenue is booked until the contract is complete. That includes if there is a loss. The only thing you would record is the loss on completed contract if it's an overall loss. But in this case, since we have a profit, we don't have to worry about that. So if you notice, in the year 2020, construction in process is debited for the full profit of $290,000 on the contract. Construction expense is $610,000, and construction revenue is $900,000. Now, then we're going to clear out our account, and if we look at our, and just again, for completed contract, no revenue or expense is booked until the contract is complete if overall profitability. What do our T accounts look like? They look like this. All we're going to do is book our costs, and then in that final year, we'll book our profit, and then we can clear them out because they both equal the $900,000. Now, if we were going to look at the difference in terms of revenue and gross profit and how it's reported, for percentage of completion, we would have recorded the revenue every year, and you would see the gross profit. For a completed contract, you would show none of that. All you would show would be revenue in the final year and the gross profit in the final year. But remember, they still come up with the same total. It's just when it's recognized. Now, the last thing we're going to cover, and this is going to be covered in Part 5, what happens if you have a loss on a long-term contract? Well, if you have a loss in the current year, but the overall contract is profitable, you're going to make your adjustment and record like you do with percentage of completion, but for completed contract, you don't do anything until the contract is complete. However, if there is an overall loss on the contract, both methods require that the estimated total loss be booked in the current period. That concludes this presentation.